Investing in cryptocurrency is very appealing to the retail investor because it gives you the opportunity to get a big outlier win that can change the trajectory of your wealth in a short period of time only with one single investment. But this home run style of investing can be very misleading for retail investors and not account for the full risk of the investment. So 9 years ago, I invested in XRP. This is a cryptocurrency. And even though the currency is now well above where I originally invested, I still ended up taking a loss. And now, as a much more experienced investor, I'm going to share with you why I was wrong about cryptocurrency, and I'm going to share with you a formula that you need to understand to become a much better investor. To set the stage for all this, in early 2017, one of my friends gave me an investment tip about a new cryptocurrency called XRP that would radically change the banking system. And at this time, I was just hearing about cryptocurrency. It was just starting to get in the mainstream and blow up. And I ended up getting in at an original investment at 30 cents per coin. This was also in 2017 when President Trump had first got elected, and the cryptocurrency space was really appealing to me because I felt like things in the United States were getting a little bit shaky, and you never know what can happen at the end of the day. So I said to myself, what the heck, let me put $10,000 into XRP and let this ride for a long-term investment that this had the potential to give me a huge outsized returns and change the trajectory of my life and my portfolio. So in early 2018, the currency ended up going crazy and spiking up above $2 from where I had started at 30 cents. And this was great and all, but everything that I had read up to this point about long-term investing and building wealth had told me that long-term investing and holding on to your investments was the true path to wealth because you had to have a long-term mindset and you avoided paying capital gains taxes rather than just selling out at the $2 mark. So I ended up holding on to the investment. Now, the result afterwards is that the price crashed down from the $2 high, and I held on to this investment all the way up till 2020 until I finally just got sick of it. It was in the dumps and I sold it for a loss. Now, years later, the price ended up going even higher, crossing the $3 mark before going back down to $1. Now, a novice looking at this situation would easily say that I was a fool for not selling when it spiked up above $2, or I was a fool for not holding on long enough and seeing my thesis play out of the long-term investment. Now, in investing, any investment you make, there's a random distribution of outcomes that can come. We don't know what the end result is because we don't have a crystal ball. And since there's a random distribution of different outcomes for any investment, we not only have to measure an investment by its long-term return potential, but we also have to measure the investment by its volatility and its total risk to get the full picture of the long-term return potential. Now, I may have just lost you right there, so let's break this down step by step. One of the methods that we can use to measure risk when we're investing in things like cryptocurrency is using the formula volatility drag. And what volatility drag measures is the gap between the return that an investment appears to make on average on paper and the return you actually walk away with in real dollars. So let me walk you through an example of this. Let's say you invested $100 in an investment. And now that investment doubles in 1 year and it's up 100%. So you now have $200. Now in the second year, that same exact investment gets cut in half and goes down by 50%. So you're back down to $100. Now, if you just look at the average return of those two numbers, it would appear that on paper, you had a positive return of 25% on average. But when you look at your account, you started with $100. You ended up with $100. Your actual real return is $0 because of the volatility in the investment. So what does all this have to do with a cryptocurrency? Well, understand when we look at the majority of cryptocurrencies, we are looking at extremely volatile assets, and this also includes Bitcoin. And when we are measuring volatility drag, we have to take into consideration that all things being equal, if we have to wait 8 to 10 years for an investment to go up and then come back, you could have been invested in another investment that had a steady growth and took advantage of the effects of compounding all along. Because of this effect of volatility drag that we have in a portfolio, and because cryptocurrencies are so volatile, we have to consider this along with the total long-term return prospect before we ever get into an investment. Now, if you don't know how to find the standard deviation of a cryptocurrency or any stock, make sure you check out my video about the 3 best AI apps for investing, where I discuss the best AI app for investment research, and I'll link that in the description at the end of this video. Now, before I continue sharing why I was wrong about cryptocurrency, if you're watching this and you are looking for a place to track the United States economy to gain a better investment edge, I built something that's just for you. Visit my website at www.financewithsantiago.com/terminal to get access to my free economic terminal. This is completely free and it updates you with the latest economic data straight from the Federal Reserve, so you can always have a bird's eye view of what's going on in markets and the economy under the hood. Now let's get back into how I solved this cryptocurrency problem. So what I was misunderstanding about investing in cryptocurrency is that I was only looking at the possibility of a large, big return over a short period of time. And then I was telling myself if I just held on to it long enough that this would happen, and not taking into consideration the volatility that existed to get this large return that I was looking for. Even if I were to hit a large home run on the investment, if I had to sit through 10 years of the cryptocurrency going up and down and having volatility, chances are I could have got a better return and been better off in something more stable and less volatile by letting the effects of compounding take over. And after experiencing this, I realized that I was approaching investing with the wrong type of mindset. If you're only shooting for super high returns by taking super high risk in investments that are very volatile, you are taking on a lot of risk that kills your time value of money. So let's look at Bitcoin as an example of this. If you invested in Bitcoin at the highs in 2021 at 64,000, you would have had to endure up to this point the brutal lows of it going down to 20,000, a ride all the way up back to over 120,000, only to be right back where you started, even though the average long-term return on paper for a cryptocurrency like Bitcoin is higher than a lot of stocks. Now, you would think that if you are investing in these high return, high risk investments like Bitcoin and XRP, that there's no way that a large, boring, established company like Visa could have a better long-term return profile. Because if you're taking on much more risk and volatility, then theoretically you need to be compensated by this risk for having a much higher long-term return. So when you look at this comparison chart right here, if you would have invested in Visa at the same time that I invested in XRP, not only would I have a higher long-term return, but I would have done it taking substantially less risk. Remember in the beginning of the video when I said that there's a random distribution of outcomes that could happen in any given investment? So we don't know which investments will work and which won't. And since we don't know what the future holds, then we need to make the most return possible, taking the least amount of risk as possible so that we can stay in the game, have time value of money working on our side, and let compounding take the effects in our portfolio. So when I realized this, I became a better investor because I stopped focusing not only on the total return on paper, but just as equally as important, focusing on the volatility and the path I took to get these returns. This is what separates really good investors from novice investors. Because of the effects of volatility drag, I now focus on trying to get the lowest risk return trade-off in my investments as possible. How can I get the highest returns with the least amount of volatility? So when I began investing in crypto, I was wrong thinking that the potential of a large return was the key to building wealth. It is not. Risk-adjusted returns are the key to long-term wealth and portfolio building. Now, me personally, I no longer touch cryptocurrency at all. Once I realized this, I was out completely because the cryptos just have way too much volatility for me to make sense of this as a long-term investment. So now that you understand the concept of volatility drag and what I got wrong about cryptocurrency, go ahead and check out my next video where I discuss the 3 best AI apps for investing so you can get a better investment edge.